Hey everyone, I'm Sam Heracli, and welcome to this Masterclass Explainer. Today, we're zeroing in on a completely non-negotiable framework for modern audit professionals, International Financial Reporting Standards, or IFRS. We're going to break down exactly what you, as an auditor, need to know to navigate these rules effectively and confidently. Let's jump right in.
So, here is our roadmap for today. We are looking at a highly structured, comprehensive 13-part framework. And listen, we're not skipping the hard stuff. We're going to unpack these critical details exactly as they're written, from the foundational basics all the way up to very specific compliance risks. By the end of this, you'll be fully equipped to tackle these challenges in your day-to-day practice. To keep things logical and rigorous, our syllabus is broken into 6 clear modules. 1. Foundation of IFRS. 2. The role of the internal auditor. 3. Key standards and judgments. 4. Risks and focus areas. 5. Application and local context. And finally, number 6, best practices and takeaways. Starting right at the top with Module 1, Foundation of IFRS Standards. Because, let's be real, you simply can't audit what you don't fully understand. As an internal auditor stepping into this space, you've basically got 5 core objectives you have to hit. First up, you need a solid grasp of the purpose and scope of IFRS. Second, you really have to know your exact role in financial reporting compliance. Third, you need to identify which key standards actually matter to your organization's financial statements. You don't need to know every single rule in existence, just the ones relevant to you. Fourth, you've got to be able to evaluate the risks of material misstatements that come from applying these standards. And finally, your ultimate endgame is supporting reliable, transparent, and comparable financial reporting across the board. So what is IFRS fundamentally? Put simply, it's a single set of high-quality, globally accepted accounting standards issued by the IASB, that's the International Accounting Standards Board. The whole idea here is to create a unified global language for business. It promotes consistency, it drives transparency, and it ensures comparability in financial statements. And this idea has spread massively. It's currently used in over 140 countries. That means an investor can look at a company in Brazil and a company in Germany and compare their financials apples to apples. Now, there are 5 vital characteristics of IFRS that you absolutely must keep in mind. First, and arguably most importantly, it is principles-based, not rules-based. This means you aren't always going to find a simple black and white checklist. Second, it focuses heavily on economic substance over legal form. For example, if a transaction looks legally like a sale but is economically acting like a loan, you account for it as a loan. Third, it demands fair presentation to give a true and fair view. Because of that, the fourth characteristic is that it requires significant professional judgment and estimates. And look, wherever there's heavy human judgment, there is audit risk. Finally, remember that these standards get regular updates, so the landscape is constantly shifting under our feet. Okay, let's pivot to Module 2, the role of the internal auditor. This is your exact mandate within this global ecosystem.
So what exactly are you supposed to be doing here? It really boils down to 5 actions. First, you have to understand the specific IFRS rules that apply to your company. Second, you have to rigorously evaluate both the design and the operating effectiveness of controls over financial reporting. Are they built right, and are they actually working? Third, you need to assess those tricky areas that involve significant judgments, estimates, and complex disclosures. Fourth, identify the risks of misstatements that happen when someone just incorrectly applies an IFRS rule. And fifth, remember that while we are independent, our ultimate role is to add value and support management in ensuring total IFRS compliance.
Moving right along to Module 3. This is the technical meat of our explainer. Key standards and the gray areas where professional judgment becomes absolutely critical.
Let's methodically break down 6 critical standards you are definitely going to encounter. First, IFRS 15 for revenue. Your focus here is making sure revenue is recognized only when control transfers to the customer, using a strict 5-step model. An example? Recognizing revenue when goods are actually delivered, rather than spreading it out over a 2-year warranty. Next is IFRS 9 for financial instruments, where the focus is classification, like amortized cost or fair value, and using the expected credit loss model for impairment. For physical assets, we have IAS 16. This says property, plant, and equipment is measured at cost less depreciation, which means you have to depreciate major components like a building's roof completely separately. Then there's IAS 36 for impairment. This tests if an asset's recoverable amount has dropped. If it has, you're recognizing a loss in the P&L. IAS 37 handles provisions, like recording a liability for a pending lawsuit, but only if a loss is probable and can be reliably estimated.
And finally, IFRS 16 for leases. This is a game changer because it brings most leases right onto the balance sheet as right-of-use assets with corresponding lease liabilities.
Because IFRS is so principles-based, management is constantly forced to make subjective calls. There are 6 common areas where this judgment gets really intense. We're talking about the timing and amount of revenue recognition, measuring fair value, testing the impairment of assets and goodwill, estimating the useful lives of equipment, making provisions for contingent liabilities, and classifying leases. These are massive gray areas. As an auditor, your job is to get in there and rigorously challenge the assumptions, the models, and the data driving every single one of those management judgments.
Knowing where things usually go wrong is half the battle. Let's transition to Module 4, looking at compliance danger zones and your primary focus areas. What are the exact compliance risks keeping us up at night? Well, there are 5 major ones. Number 1, incorrect interpretation of complex standards. 2, inconsistent application across different reporting periods. You can't just flip-flop your accounting policy every year to make the numbers look nicer. 3, incomplete or unclear footnote disclosures. 4, and this is the really dangerous one, management bias in estimates. Human nature inherently leans toward assumptions that flatter the financials, and we have to be the objective check against that bias. And finally, the 5th risk is simply missing updates to the standards and failing to apply them on time.
So, to actively mitigate those risks, here are your 5 internal audit focus areas. First, review your organization's accounting policies to make sure they actually align with IFRS. Second, test the key controls that govern transactions, estimates, and disclosures. Third, fiercely evaluate management overrides. If a perfectly good automated control was suddenly bypassed, you need to know exactly why. Fourth, review the financial disclosures for completeness and clarity. And fifth, always monitor for changes in IFRS so you can assess their impact before they become a problem.
All right, moving into Module 5. This is where we take these theoretical, global frameworks and look at their practical, real-world execution, especially how they adapt to local requirements.
It's really vital to understand how global standards bend to fit local contexts. India's INDAS is a prime side-by-side example of this. IFRS is truly global, issued by the IASB, used in 140-plus countries, principles-based and continuously updated. INDAS, on the other hand, is issued locally by the ICAI and is mandatory in India. It is converged with IFRS, meaning it's principles-based and shares the same core DNA, but it is adopted with specific, mandatory local carve-outs to fit the Indian economic environment. The takeaway here, even if you are a master of global IFRS, you absolutely have to know your local requirements.
Let's look at 4 concrete real-world examples and the specific audit considerations for each. For revenue under IFRS 15, say a company hits a milestone in a construction contract. Your audit consideration is to check the actual performance obligations and see exactly how the transaction price was allocated. For financial instruments under IFRS 9, if an equity investment is classified as fair value through other comprehensive income, you've got to verify that classification in the corresponding impairment assessment. For leases under IFRS 16, when an operating lease hits the balance sheet, you need to review the underlying lease contracts and literally recalculate the right-of-use asset math. And for impairment under IAS 36, if machinery has a low recovery amount, your job is to dig deep into the cash flow assumptions and the projections that management used for that impairment test.
Now, implementing all of this, it is no walk in the park. Organizations face 5 major hurdles. First, the sheer complexity of these principles-based standards. Second, the incredibly high volume of subjective judgment and estimates required. Third, it demands deep expert knowledge and constant training. You really can't just guess your way through this stuff. Fourth, implementation often requires massive IT system and process overhauls. And finally, IFRS disclosures demand exponentially more granular data and analysis than older reporting frameworks ever did.
Which brings us to our final module, best practices and takeaways. Let's equip you with the essential tools you need to wrap this all up.
Here are 6 definitive best practices you need to adopt today. 1. Stay obsessively updated on new or amended standards. 2. Deeply understand your company's business model. Seriously, you can't audit the numbers if you don't know how the business actually makes its money. 3. Rigorously evaluate the controls governing those tricky IFRS judgments. 4. Use outside experts for things like complex valuations, tax, or legal issues. Asking for help is a sign of strength. 5. Hyper-focus on your disclosures for completeness, accuracy, and clarity. And number 6, above all else, maintain your professional skepticism. Always ask why, and always demand the evidence.
Before we finish, I want to leave you with a core philosophy for this work.
It goes exactly like this. A strong understanding of IFRS enables internal auditors to evaluate financial reporting risks effectively, assess control effectiveness, and ensure accurate, reliable, and transparent financial statements that enhance stakeholder confidence. Mastering IFRS isn't just about compliance, it's about directly boosting the trust that stakeholders have in your organization.
So if you take absolutely nothing else away from this explainer, remember this ultimate equation. Deep IFRS knowledge, combined with strong internal controls, directly leads to reliable financial reporting and better audit quality. It's essentially a mathematical certainty. When you know the principles and you test the controls, the result is undeniable quality.
As you go back to your teams and your daily audits, I want to leave you with one final thought to chew on. Are your internal controls truly ready to handle the rigorous judgment calls that IFRS demands? It's a tough question for sure, but answering it is exactly why you're there. Thanks for joining me for this explainer. Keep learning, keep pushing back, and I'll see you in the next one.